As of right now, gold has just blown past $5,500 an ounce, and it's accelerating. We've seen charts spike like this before, but never quite like this, straight through resistance levels that used to hold for months. The price isn't just up, it's shattering expectations in real time. But here's the question no one's asking out loud in the mainstream feeds. Why isn't anyone calling this what it truly is, a full-blown central bank panic buy? They're not dipping in for fun. They're rushing the exits from paper assets. Admitting that would mean admitting the entire post-1971 system is cracking at the seams. And once that narrative breaks, the real movers right now aren't retail traders chasing momentum or hedge funds leveraging futures. It's the central banks, quietly, methodically, at scale we haven't witnessed since the final days of Bretton Woods. China keeps adding hundreds of tons without fanfare. Poland, India, Turkey, they're not just diversifying anymore, they're escaping. Even surprise players like Singapore are showing up in the flows. These aren't speculative bets. These are strategic reserve shifts by institutions that see the writing on the wall before the rest of us do. They know something we don't yet. And what they're doing speaks louder than any press conference. For decades, we've been sold the same polished lie. Fiat currencies are stable. Gold is a barbarous relic, best left in museums or jewelry boxes. Remember 1971? Nixon slammed the gold window shut, told the world the dollar would remain as good as gold, promised endless prosperity without the anchor. Fast forward through rounds of quantitative easing, ballooning sovereign debt, stealth inflation, quietly eroding purchasing power year after year. The system held together with tape and promises. Now gold punching through $5,500 isn't a blip. It's proof the old narrative is dead. They can't suppress it forever. The physics of money are reasserting themselves. Let me break it down simply so it lands. Gold isn't just a shiny metal. It's the ultimate anti-fiat asset. When trust in paper currencies erodes, and it is eroding, central banks always revert to what's real, tangible, and no one else's liability. Right now, their buying isn't optional. It's survival mode. They're offloading dollars, euros, treasuries, whatever they can liquidate quietly, and stacking physical bars in vaults. This isn't greed driving the price. It's fear. Pure, institutional fear. And if the people who print the money are panicking enough to hoard gold at these levels, what exactly should you be doing? The catalyst didn't creep in slowly. It slammed the door in late 2025. Geopolitical flashpoints kept escalating. More sanctions backfiring. Dollar payment rails getting weaponized against former allies. BRICS nations openly building parallel systems. Central banks that had been quietly accumulating for years finally said enough. Monthly net purchases jumped from the low hundreds of tons to thousands in annualized terms. Official reports still try to downplay it, but the physical delivery numbers to COMEX, LBMA, and Shanghai don't lie. Gold crossing $5,500 isn't a speculative top. It's the new floor from which the next leg will launch. Central banks are now trapped in a no-win scenario that gets uglier by the quarter. Option 1. Keep printing and monetizing debt to avoid immediate default or recession. That floods the system with more currency units, accelerates inflation, destroys confidence in fiat, and sends gold parabolic. Option 2. Actually tighten, stop the presses, let rates stay high. That triggers a sovereign debt crisis, crashes asset values, tanks growth, and still destroys faith in the currency, because people see the emperor has no clothes. Either path ends in the same place, eroding trust in paper money. There is no clean exit hatch anymore. Now watch how the chain reaction unfolds, step by brutal step. The dollar index weakens under sustained selling pressure from reserve managers. Treasury yields spike as foreign buyers pull back. That forces margin calls on leveraged bond positions, triggering forced sales of treasuries. Those sales push yields even higher, which weakens the dollar further. Emerging market central banks, already underwater on their dollar-denominated debt, accelerate dumping treasuries to buy gold instead. Every ton of gold they acquire tightens supply, pushes the price higher, which validates the fear, which brings in more buyers. Currency devaluation accelerates across the board. The feedback loop doesn't just tighten, it coils. One domino falls, the rest follow with terrifying speed. Here's the part most people still don't want to accept. The old power centers have lost control. The Federal Reserve and the ECB can still give speeches, run interventions, jawbone futures markets lower for a day or two. But they're no longer in the driver's seat. The initiative has shifted decisively to the east. When the People's Bank of China or the Reserve Bank of India decide to take another 1,000 tons off the market, Western institutions can complain. They can short paper contracts. They can leak stories about overvaluation, but they cannot stop the physical metal from moving. The flows are happening in vaults, not trading screens. That's a power shift we haven't seen in 50 years. This brings us to the brutal divide between paper and reality. Paper gold, ETFs, futures, unallocated accounts can be printed, rolled, manipulated, rehypothecated. There's always more paper claims than metal backing them. Physical gold, not so much. You can't create another bar out of thin air. Central banks aren't buying GLD shares or futures contracts. They're taking delivery, airlifting 400-ounce bars into their vaults, or having them cast locally. That's the reality layer. Meanwhile, your 401k, your stock portfolio, your corporate bonds, they're all paper claims on a system that's quietly crumbling underneath. Gold is the one asset that isn't simultaneously someone else's liability. When the music stops, that difference matters more than any annual return spreadsheet. What we're witnessing is the greatest wealth transfer in modern history playing out in slow motion until it isn't. The late adopters, the ones still fully parked in fiat cash, bonds, and index funds, are losing purchasing power every single day the price grinds higher. Their savings buy less, their pensions buy less, their future paychecks buy less. The early stackers, and especially the central banks that started moving years ago, capture massive, real gains. If you're still all in on the old system, you're not neutral. You're on the losing side of the transfer. Don't listen to what they say anymore. Listen to what they do. While financial television anchors talk about transitory inflation and soft landing, the very institutions that underwrite the system are doing the opposite. They're loading up on the one asset they spent decades telling everyone was obsolete. The central bank reserve reports, the import-export data from refineries, the silence from Western treasuries when asked about their own gold. These are the signals that actually move markets. The old rules are officially dead. The classic 60-40 portfolio, buried. The advice that gold is too volatile for serious allocation, that was written when gold was capped and suppressed. The idea that diversification means spreading across more paper assets, obsolete. The new rule is simple. When the issuers of money start hoarding the thing they claim isn't money anymore, you pay attention. This isn't some abstract macro trend playing out in distant capitals. It's already hitting your daily life, and it's about to hit harder. Groceries that cost you a certain amount last year are quietly up another 10, 15, 20% as currencies lose ground. Rent, fuel, insurance, everything priced in weakening fiat keeps creeping higher. Your cash savings, they're eroding in real terms every single day the price of gold marches up. Retirement accounts loaded with stocks and bonds look fine on the statement until you adjust for what those dollars will actually buy in 5 or 10 years. This isn't hypothetical anymore. It's in your wallet, right now. Here's where it turns into a doom loop, and we're already inside it. Central banks buy more gold because trust is fading. That buying tightens physical supply and drives the price higher. Higher prices validate the fear, which brings in even more buyers, both institutional and eventually retail. As the price accelerates, more people wake up to the erosion of their fiat holdings. They rush for the exits, selling paper assets to chase hard money. That rush weakens currencies further, forces more printing to plug the holes, spikes inflation expectations, and sends gold even higher. Fear feeds fear. Buying begets buying. Once confidence fractures at this scale, there's no gentle way to restore it. We're still in the early innings of that self-reinforcing spiral. Most people haven't even noticed the loop has started. Look back through history, and the pattern screams at you. The 1970s stagflation crushed the middle class, while gold went up tenfold. Roman emperors debased the denarius century after century until it was nearly worthless. Gold preserved wealth then too. Weimar Germany printed trillions overnight. Those with gold survived, everyone else was wiped out. Every single fiat empire in recorded history has followed the same playbook. Expand the money supply until the system buckles. Promise it's under control, then watch trust evaporate. Gold doesn't cause the collapse. It's simply what's left standing when paper fails. History isn't repeating word for word. It's rhyming, and the volume is getting louder. We are crossing into a new monetary era, whether we like it or not. The unipolar, dollar-dominated, debt-fueled system that defined the last 50 years is giving way to something multipolar, fragmented, and increasingly anchored by hard assets. Central banks in the East aren't waiting for permission. They're already building the next framework around gold and alternative settlement systems. Deny the shift, and you'll find yourself holding assets measured in a currency no one trusts. Accept it, internalize it, and you can position yourself on the right side before the crowd rushes in. You're not powerless here. You're watching this video. That already puts you ahead of 99% of people who are still asleep to what's unfolding. The individuals who recognize this early, who act while gold is still only at 5,500, while physical supply is still available, are the ones who preserve and grow real wealth through the transition. Knowledge like this is the ultimate edge. Most won't get it until it's far too late. Physical gold allocation isn't about chasing get-rich-quick schemes or trying to time perfect tops and bottoms. It's insurance, deliberate asymmetric protection against the exact kind of systemic erosion we're watching accelerate right now. You don't need to go all in overnight or risk more than you can afford to set aside. Start with the fundamentals. 1-ounce bars or widely recognized coins from sovereign mints like the Perth Mint, Royal Canadian Mint, or U.S. Mint Eagles. Products with tight spreads, strong liquidity, and verifiable authenticity. Buy from dealers with transparent pricing, audited inventories, and solid buyback policies. Avoid anyone pushing massive premiums or sketchy storage schemes. For storage, small amounts can stay in a quality home safe, rated for fire and theft. Larger positions deserve allocated, segregated vaulting. Places like Singapore, Zurich, or London free ports, where your metal is insured, audited regularly, and titled directly to you, not pooled or rehypothecated. But here's what actually matters most: the size of your allocation relative to your overall net worth, and the timing of when you build it. Institutions aren't buying retail numismatics or fractional ETFs. They're taking delivery of large, good delivery bars, often 400 ounces, cast to exact specifications. Retail investors rarely access those channels directly, but you can mirror the logic. Prioritize physical over paper. Focus on forms with the lowest counterparty risk, and scale in methodically as the trend confirms rather than all at once. Avoid leverage, avoid margin, avoid anything that turns hard money back into someone else's liability. This isn't speculation. It's positioning for a world where trust in fiat continues to fray. And the window to do it at relatively calm prices is narrowing every week the central banks keep stacking. The data doesn't lie, and it doesn't wait for permission. What you're seeing in reserve flows is the clearest signal we've had in decades that the old playbook is finished. Protect what you've built before the next leg of repricing makes entry far more expensive. If this is hitting home and you're serious about not getting caught flat-footed, take the next step right now. Hit that like button. It helps get this in front of more people who need to see what's really happening. Subscribe and turn on notifications so you don't miss the updates when new reserve data drops, when another BRICS announcement lands, or when price action shifts decisively.